This lecture will focus on the risk and return concepts covered in chapters 6 and 24. You should have already read your readings from these chapters and done the practice problems. As you read, the history of financial markets tell us that in general, in the long run, investors who are willing to take higher risks will be rewarded with high return. However, not all investment risks will be rewarded with high return in well-functioning financial markets. The total risk of a stock investment or other investments can be measured by estimating the variance of the past stock returns. The variance is dispersion or deviation around the mean return, and it measures both upward as well as downward price movement. The risk to investor is simply the downward price movement, which is the potential of losing money. This total risk or variance of a single stock has two components: systematic or market risk and unsystematic or company-specific risk. The unsystematic of the stock can be eliminated through diversification, which is essentially spreading your investments among several industries. Hence, investors are not rewarded for taking this risk. The systematic risk of an investment is due to macroeconomic factors such as interest rate, inflation, GNP growth rate, and wars, and this systematic risk cannot be eliminated. Financial markets reward investors for only taking systematic risk. We calculate this systematic risk by estimating the beta of a stock. So beta risk is the only risk that matters. The huge financial industry is based on this idea of eliminating unsystematic risk of stocks, because most mutual funds hold portfolios of stock, often more than 40 stocks in each mutual fund. The idea of portfolio diversification or eliminating unsystematic risk depends on combining investments that do not move in the same direction. The best way to eliminate unsystematic risk of stocks is to combine stocks that have very low positive correlation or negative correlation. The remaining risk will be the beta risk or systematic risk. The expected or fair return on a single stock or a portfolio will be related to beta risk, and this return can be estimated using the capital asset pricing model known as CAPM. This fair return may be higher or lower than the actual returns, which will tell us if the stock is currently underpriced or overpriced. A more generalized version of CAPM model is the arbitrage pricing theory known as the APT model, which includes CAPM as a special case. Essentially, APT uses the beta risk from CAPM and additional risk factors to price stocks. This is essentially what you should have learned from chapters 6 and 24.